And that would have meant 39.75 sell side. You would then have put a hard stop at the top edge, and you would have been going for that trade there. So your original trade idea would be basically something that looks a little bit like that, and the outcome in terms of return on account is now about 3.6 times your money. Now obviously if you were to trade it in terms of a structural sell, using a systems process of simply a red candle or the green candle reversal, which is what we tell you about, your actual sell would have been here. So you'd have been able to reduce the size of your stop significantly, and that would have meant that you would have ended up making 7 times your money. Now, if you took a different system sell, and when you saw the sell-off, you then looked for the next sell-off, assuming you maybe got scratched at break-even, which you would have done on that trade, you would have got scratched at break-even, you'd have had to come back in again, wouldn't you? Well, that's part and parcel of trading, guys. You've sometimes got to come back in, and there's your next sell opportunity there. There's the high print there. Add 1 tick to that, and there's your next sell right there. And all of a sudden, you're making 5.6 times your money. Take your pick. Every single one of them is a possible sell, but the point is, I suppose, you've got to be in one of them. Yes, you've got to be in one of them. Now, why is Mike so excited about the sell on the S&P? We told you this yesterday, didn't we? We actually ran a classroom on this yesterday. And we talked about that all-important driver in the markets at the moment, and that's the US dollar. So if we know the US dollar is one of the all-important drivers in the markets at the moment, is it reasonable to start suggesting that you should put the Dixie on your charts? 1 over DXY, guys, 1 over DXY on your charts. What does that show you about the quality of that sell? Was it a good sell? Was it a terrible sell? What the hell is Mike talking about type of sell? What do you think, guys? Was it a good sell or a terrible sell? Yeah, it was a pretty solid sell trade. It was a pretty solid sell trade. So we can see that this idea of shorting into that measured move, the idea of shorting into the wholesale price, which we already tweeted 13 hours ago, the idea of getting into that bit of business in that area and running it back through the process in line with that dollar sell, that dollar buyer, but inverted for a dollar sell, it gives you a couple of really good clues about the shape of the market at higher print prices, at key structural levels. Because remember, when we tie in the idea of that structural level, what is it the dealer's asking at that price? Because they're asking a very important question. What's the dealer actually asking, guys? You know that 4140, 4142 is a big option dealer's level. They've got 2 choices. Do I hedge this price, which means buying S&P above potentially, or do I defend this price, which means selling S&P here on the way up? Do I try and defend into this? You might say, well, it's actually them hedging it back in because they've unwound previously. Well, whatever it is your way you're going to look at it, the dealer wants to make a decision. Do I sell the S&P here, yes or no? Well, how do they answer that question? They answer that question by looking at whether they potentially could hedge out their exposure to this trade. If they do sell it, could they hedge out their exposure? Well, if I'm a dealer and I'm looking at 4142s, I could look at that and say, well, I could hedge out an awful lot of my exposure by simply trading the black line, couldn't I? The difference between the S&P and the black line is quite significant. I would imagine that the difference between those would probably reverse and reduce significantly at some stage. So I could certainly sell some S&P, and assuming the S&P starts falling, I could start buying some black line, which means selling some dollars. So I could sell the S&P and sell the dollar at the same time and end up with a hedge type position, or a pairs trade if you like. And a pairs trade is obviously a trade that ultimately is just about trading the divergence, the widespread divergence versus then the contraction of those pairs. And the dollar against the S&P has that kind of quality about it. So for example, if I looked at buying the S&P down here, and then I saw the dollar spiking like this, I could easily have then sold the dollar here, or bought the dollar, as you know, because it's inverted, but I could have sold the black line there, buying dollars. And obviously, if I took those two trades as a pairs trade, simply as a pairs trade, well, the S&P went up and the dollar went up as well. You ended up making a double alpha trade on that pairs trade. So this hedge works. This hedge makes a lot of money. So when we look at this as a hedge idea, when we look at this idea of the dealers asking the question, well, you need to put yourself in the same position as them and say, if I was a dealer, what would I defend this price now? Would I actually want to defend this? And obviously we're coming into a massive volume, and you say, well, there's massive volume. It looks like they're defending it. And sure enough, the low volume retest and then the sell away has been absolutely fantastic. It's not about one piece. It's not about the dollar. Mike's not saying that it's about the dollar in isolation. Because if it was about the dollar in isolation, you'd have been selling this price as well. You'd have been selling 34's previous session highs, wouldn't you? If it was just about the dollar, you'd be selling there because the dollar was bullish and it was getting more bullish, so you'd sold here. Well, we did sell there. So it's not just about the dollar, is it? That's not what Mike's saying. What Mike's saying is it's about the narrative, the whole narrative. So if the price continues to rise, we're now getting what's called a guaranteed premium. The value of the dollar hasn't materially altered. So because it's now a guaranteed premium, all the liquidity, all this balance area liquidity this morning is now gone. It's been swept away. Now the best sell is available. And it wasn't just the best sell. Then you see the big volume coming in, and then you see the measure, and then you see everything else, and you see it's at the 40 level, and you go, wow. That's the story. Everything lines up for that sell trade. Everything lines up for that probable sell. That's what the story is. That's what Mike's pointing out. It's not about the dollar, but the dollar is a big piece of it. The dollar brings your eye, perhaps, to the whole idea. But it doesn't have to be the dollar that brings your eye to it. It could have been the massive volume. It could have been the 40, 42s. Could have been the reason why you got brought to it. It doesn't matter what reason you got brought to it, because you still have to put in the work with all the other elements before you make a trading decision. And then we get this brilliant sell away from 42s down to a low price of 29s, and you make yourself a very, very, very substantial amount of money on the short sell swing. Very good trade, guys. Very good. Well done, lads, if you've taken it. I like your style. I like your style. Cash open in about, 30, 40 minutes. 40 minutes cash open, guys. 40 minutes. I was talking about bonds